Procter Gamble. You know the name, right? For what feels like forever, it's been the poster child for stability and those sweet, reliable dividends. I mean, it's a cornerstone of countless portfolios. But the question we have to ask is, does this old-school Dividend King still deserve its crown? Is it really a fortress for your wealth, or is it actually a trap that's costing you a fortune in missed opportunities? Let's dig in.
And that's really the big question we're tackling today. To figure this out, we're going to do two things. First, we're going to build up the bull case, what we're calling the fortress of profit. And then we're going to look at the other side, the bear case, or the high price of safety. So let's start with the good stuff.
All right, first up, let's talk about why so many investors absolutely swear by this company. It really all comes down to its incredible, almost unbreakable fortress of profit.
So this right here, this is P&G's superpower, what investors call its economic moat. Just look at that gross margin line. It consistently stays above 50%, even when inflation is going crazy. That, my friends, is pure pricing power. I mean, think about it. You know Tide, Pampers, and Gillette. We trust these brands, so P&G can raise its prices to cover its own rising costs, and its profitability barely even flinches.
And all that pricing power, it fuels this ridiculously efficient engine, which we can really see when we look at its return on invested capital, or ROIC. Now, all this metric does is measure how good a company is at turning its money into more money. And let me tell you, P&G's performance here is absolutely elite.
I mean, just look at that number, 41%. Let that sink in. For every single dollar P&G puts back into its business, whether that's for new factories, marketing campaigns, whatever, it spits out over 40 cents in return. That is the very definition of a world-class, wide moat business. It is a machine designed to do one thing exceptionally well: make money.
So what does P&G do with all that cash it's making? Well, it doesn't just sit on it. It sends it straight back to people like you and me, the shareholders. In 2025 alone, the company is expected to return over $14.6 billion through dividends and stock buybacks. It's basically a wealth extraction machine. It takes the profits and just hands them right over to its owners. And that's the core of the bull argument. It's predictable, it's powerful, and man, is it profitable.
Okay, so that all sounds pretty great, right? But, and this is a big but, all that safety and predictability comes at a price. And sometimes it's a very, very high one. So now, let's unpack the bear case and look at the other side of the P&G coin.
And wow, does this chart tell the story? Look over here on the right. The S&P 500 is just roaring ahead, with a return of almost 75% over the last 5 years. Now look at P&G on the left. Sure, it delivered a stable return, but it was a much smaller 26%. That's a performance gap of almost 50%. So while P&G was keeping your money safe, the rest of the market was out there making a whole lot more of it. This is the opportunity cost of playing it safe.
So why that huge gap in performance? Well, it all boils down to revenue growth, which you could honestly describe as a slow-motion staircase. Yeah, it's consistent, but it's barely moving upwards. I mean, going from $70 billion to $84 billion in 6 years, that's reliability for sure, but it's not growth. And in the stock market, growth is what really drives those big returns.
And this, right here, brings us to the absolute heart of the bear case: what you're paying for all this safety. See, the market knows P&G is a safe bet, and it makes you pay a very high price for that comfort. Investors are currently paying a price-to-earnings multiple of nearly 24. That's the kind of price you'd normally expect to pay for a fast-growing tech company, not a consumer goods giant.
Okay, let's just boil this down to the raw numbers, because it's kind of wild. On one hand, you're shelling out a multiple of almost 24 times what the company earns. And on the other hand, what you're getting for that price is revenue growth of, wait for it, 0.3%. This is the great disconnect. The bears are basically screaming, you're paying a premium, tech-like price for flat, utility-like growth. And that is a huge risk if the market ever decides it's done paying for safety.
All right, we've seen the good, we've seen the bad. We've looked at the fortress of profit and the high price of safety. So let's pull it all together and figure out, what's the final verdicts here? What kind of tool is P&G really?
So let's put it all in one bucket. The bull case, right? Why would you buy this stock? Well, you buy it for its world-class efficiency, its totally protected profit margins, those clockwork dividend payments, and the fact that it holds up when markets get turbulent. It's the perfect stock for someone who has already built their wealth, and now their main goal is just to protect it and generate some reliable income.
And on the flip side, the bear case. Why do you stay away? You avoid it because it lags the market by a lot. There's a big valuation risk paying so much for so little growth, and honestly, there's a pretty clear ceiling on how much it can grow. This is the opportunity cost that should be on the mind of any investor who's still trying to build their wealth.
So if we were to give P&G a report card, this is pretty much what it would look like. For safety, it's an A+, no question. For profitability, a solid A. The company is an absolute cash machine. But then we get to growth, and it's a C-. It's just not really there. And that directly slams its value grade, which also gets a C. You're just paying too much for too little growth.
You know, this line just nails it. It's the whole story in one sentence. Buy P&G to stay rich, not to get rich. It is a tool for wealth preservation, not for wealth creation. Simple as that.
So that really leaves us with the big question. And this one's for you to think about. Based on everything we've just gone over, where does a stock like Procter Gamble actually fit in a modern portfolio heading into 2026? Is that safety really worth the high price tag, or is the opportunity cost just way too much to ignore?
And of course, just a quick reminder that this analysis is purely for informational and educational purposes. It is not financial advice. All the data sources we used are listed right here on the screen, and you should always consult with a qualified professional before making any investment decisions.